So, identify and explain the main audit procedures when valuing investment properties. So remember our technique. We think of the method, generally AEIOU. Could be any method, obviously, but that's what we use. Then think of the what. So what document or who, if it's a person. And then don't forget, why are we doing this? If we do, because that's the explanation. So if we do it, we'll make sure we get all the marks. So, first of all then, we need to inspect the written instructions that Poppy gave to the valuer. Because then we can see the scope of the work. So we make sure that the valuer knows the scope and knows what is required to do, and also knows the intended use, okay, which should help with the IAS 40 stuff, so that he knows the intended use. We will examine the valuer's report, and we will examine the assumptions used in getting to this report. So when we look at those, we'll see that if they are in line with other evidence, in line with our knowledge of the business. We will also examine the methodology that they used and ensure that it's in line with IAS 40, the way they value or suggest you should value investment properties. We want to examine the methodology used as well for each property. So making sure that it's consistent, they've all got to be treated the same way. We could inspect the properties themselves, and then we can see that if there's any physical damage, what's the physical condition, and is this in line with the valuations? Keep going. What else could we do? We could inspect a purchase invoice for the property, and that should help give us a range for the fair value, because if it was bought mid-year, then the fair value presumably is pretty similar to the cost. And if it was bought 2 or 3 years ago and you know more or less what's happened to the market, it will give you a reasonable range. Investment properties are valued for their rental income a lot of the time as well, aren't they? So we could review the forecasts of rental income. Okay, and see the effect, see if that supports the fair value amount that the valuer has put on it. We could examine post-year end sales again for the same reason. Have there been any post-year end sales of investment property? Would that support the fair value? And finally, we could inquire, we could ask of management to have a management representation that the assumptions used are reasonable in their opinion, okay? And we're talking here about the significant ones, the significant assumptions. Okay, so they're the sort of things you would think of, I think. Use that methodology. If you can come up with, say, 6, you're going to get there. We came up with a lot more, but just practice these questions. That's the way to do it. Get thinking about it, and then in the exam you'll find it a lot easier.